up ahead. Affirmative 612.
This week on the Wealthy Pilots podcast, the stock market is scary good, and it's Halloween, so we figured it'd be a good time to talk about this, Scott. It is on a tear this week. And of course, it looks like, the impending trade deal with China and some other things. But we also got to be mindful. It's awfully exciting when it's scary good, but we all got to be careful because it could someday be scary bad too.
Yeah.
So in the, in the context of Halloween, how you doing, my friend? And what do you think about what's going on? And what should we think about? What should we be thinking about?
I think the number one thing that comes to my mind when we talk about the market being scary good, is, that old Warren Buffett quote, which is to be greedy when others are fearful and fearful when others are greedy.
Okay.
And where I go with that is it can get easy when the market is in a significant uptrend or a significant downtrend to get caught up in the emotional side of our decision-making process. And that's where, to me, I think you really have to take a step back. We talked a little bit about this in previous episodes and really just think about our long-term plan. I've heard that with people on the call before where they are hesitant to invest in the market because the market's at an all-time high. Well, the market is at an all-time high most of the time. I mean, it's generally going up about 8 out of 10 trading sessions. It's going up. If it's not an all-time high, it's just off an all-time high typically. The one flip side to that would be when the market is, in some sort of correction or a bear market or, a deep bear market during a recession or something like that.
Right.
And those time periods happen, but candidly, the folks that I meet with that are concerned about putting money when the market's going up are not really the ones that I would say are super disciplined to say, hey, the market is cratering. Let's get the money in the market. And so, to me, I think I hear this from folks typically when they're sitting on a large portion of cash, or if they're in the last, I'll say 5 to 7 years of their working career, especially for a lot of our pilots. I mean, they got, a nice chunk of change that they're coming into retirement, right? I mean, a couple $1 million typically at least. And if you're sitting on $2 to $5 million and you start to think, what if the market goes down 40%, 50%. It can be really scary to think about, losing half of your life savings when you're no longer working.
Yeah.
And so sure. I understand where that fear comes from. Absolutely. But to me, in God we trust, all others must bring data, right? So we got to look at what does the data say? And if you look back and you say, if I invest at an all-time high and I look a year later, 3 years later, 5 years later, 10 years later, across the board, it generally doesn't matter. There's a slight difference between the returns, whether the market's at an all-time high or it's not. Now, if I happen to invest when the market's at let's say a 5-year low, if I bought the market at the end of its COVID drop, yeah, those returns are going to be significantly better when I buy it at the very bottom. But nobody can time tops and bottoms.
Right. And that's the struggle, because right now we're seeing it climb like crazy. People are very excited. At the time we're actually talking, this is the beginning of a 2-day meeting between the Fed and the Fed Commission. So they're expected to maybe cut the rate tomorrow. That's potentially on the radar. So that's spiking it. Looks like Nvidia is going to buy into Nokia with like $1 billion worth of assets. So AI basically is driving a lot of things right now, along with everything that's going on. So it's very tempting, Scott, to your point, to go, yeah, but I want to get in on that gravy train, right? I want to get in on that gravy train. So you got to be careful. That's the scary part.
It is, right? But if we pull back the emotional side and the news and the headlines, we know that we've heard us say this many times, right? The market responds to news. News is unpredictable. Therefore, the market is unpredictable.
And it's been good news this week, so it likes it.
And if we look back on the history of the last 100 years of American history, global history, is there bad news in the last 100 years? Absolutely.
Often.
Absolutely. I mean, we got endless wars, natural disasters, recessions, etc. But when we look year over year over the last 10 decades, and you look at everybody's lifestyle and the growth of the globe and our economy, it's generally really, really good news. And so in general, the market has really done well because we've generally had a really good news.
Right.
And so, again, if we say, all right, we're not going to worry too much about the news. Let's just look at what the data says. All right. If I'm at an all-time high, if the market's at an all-time high versus it's not at an all-time high, those are the two conditions for this test. Okay.
Okay.
What are the forward-looking 1, 3, 5 year returns? Okay. 1, 3, and 5 year returns. If I'm at an all-time high or I'm not, I'm at 9.4% versus 9.1%. Here in the Midwest, we call that irrelevant. Doesn't matter. 9 point versus 9.1. Roughly 9%.
Negligible.
So 3 years after you're at an all-time high or off an all-time high, 29% versus 27%. Again, I've never had one person say like, hey, looking back, I wish I would have done X, Y, Z because I would have been at 29% of my 3 year returns instead of 27. And then looking back or looking forward for the 5 year returns, 50% 5 year returns versus 48%. So when the market's at an all-time high, the data would tell us it's actually a good time to invest because many times these bull markets tend to go on like good news, builds on good news, right?
Right.
And so when the market's at an all-time high, a lot of times we see that momentum, right? And we're in the middle of one of those momentum swings right now. I mean,
Could
if you
be.
just look at it, it's Is that going to last forever? Mark, I hope so, but brother, the data doesn't support that either. We are going to get a correction, right? I mean, we had a 4% sell-off just a couple weeks ago because of the news of the China tariffs, right? And that was a little setback, and now it's coming straight back up. And
April was down 15% because of tariffs being implemented, period, right?
100%.
But we haven't had the prolonged. That's the thing. The prolonged one, like the couple years one, we haven't really seen since the Great Recession, since the housing crisis, right?
Absolutely. Yeah, I mean,
and so we wonder, when did the shoe drop,
And that fed a global financial collapse, right? I mean, that was a global financial and market issue.
And let's be honest, Scott, we're approaching 20 years. I mean, if you're really honest about a prolonged downturn, 07, we are approaching 20 years without a prolonged downturn. Yeah, the COVID blip. Yeah, in 22, the inflation spike, it was down a little bit. There's been corrections, to your point. There's been, and the market always does that. I think people wonder when it's doing this good, A, they don't want to miss out like we've been talking about, but B, boy, if I do get all in, I just know it's just my luck. We're going to hit the next Great Recession, and it's going to be a 2-year downturn.
Well, and you know what? If you're sitting in all cash right now, scared of the expensive market, I do understand that, especially if you're near the end of your career.
Absolutely.
And I've talked with, folks that have that going on, and it's a concern because in their heart of hearts, they also know it's not sustainable for me to sit in cash for a 30-year retirement either. They know that.
Yeah.
They know that. And so to me, there comes a point of like, I guess a sports and military analogy both came to me, but like getting back in the game or getting back in the fight, like, hey, the very first thing you got to do to get back in the fight is like, you have to take that first step. And then a lot of times, like just defining the first step of like, all right, let's not take your $3 million of cash and put it all in the market today. Cause I can guarantee you, I can't guarantee anything, but I was
going to say, don't say that.
I would strongly say that the day you put the money in the market's probably going to be down 2% that day, testing your resolve. Right. But realistically, and all jokes aside, we can do, almost like a dollar cost averaging thing. We're like, hey, let's put a chunk in every single month for the next year. And then if there happens to be a big dip, we can plow a bunch in and take advantage of it. Yeah. If you're not wanting to make a big emotional decision the other way too. So
true.
Because you want to have a plan that you can stick with. That's the most important part. But the main thing I wanted to hit today was really like the data does not support that. Because the market's at an all-time high, I should be on the sidelines waiting to buy the dip. Because the thing that people will say, and I'll pick up my brother for this point here before we wrap up. I remember him telling me, hey, dude, like I found this old 401k I had. It had like 80 grand in it or something. It wasn't a huge dollar amount.
All right.
And I discovered it from like one of my first employers right before the COVID crashed. And I was able to put all the money in the market and take advantage of that 33% S&P 500 dip in a month. I was like, wow, dude, that's awesome. Hey, out of curiosity, what was it, the 401k in the market, or no, it was sitting in cash? Okay, well, let's look at it. When did it go into cash? So we pull a because I just was curious. I want to do this thought experiment. So we pull a statement. We find like, dude, because you missed out on you missed out on 6 years of growth. And when there was this dip, you felt really good about buying. Man, I bought at the very bottom. I was so lucky. It was awesome.
Right.
But when you ran the numbers and just said, well, if it was just in the market and you had that growth and then that dip and then the growth after, you would have been way better off. I mean, it was like he had missed out on, and that's the thing, that opportunity cost of missing out on all this. And so when people are talking to me about like, hey, should I put money in? I mean, the smart aleck response is like, no, wait till it goes higher, because 80% of the time it's going to go higher. I mean, that's just what the data says. 8 out of 10 times the market's going up, and that's for trading days. That's for trading years. It's just what the data says. So, but
we got to get in at some point. So, if
I got to get in, I'm just going to get in now typically, because it's, again, the data suggests that if I'm waiting, I'm probably waiting and it's going to go up. And so if I wait till it goes up 10% higher from a certain point, and then all of a sudden there's some 10% correction because of the news, and then I buy, I might feel better about that, but I'm no better off because of the compounding time of money. So, yeah.
I was going to say, kind of like me waiting to get my house sited, thinking, oh, I'll just wait and do it later. But contractor costs just keep going up. And so it just didn't, all it did was hurt myself. So,
yeah, look, we'll wait till contractor costs get cheaper.
Yeah.
I don't know when that's going to happen.
Yeah. You got a better chance of predicting when the market might go down.
Exactly. So, I mean, the key takeaway here, though, is, hey, it can be scary to invest in a quote unquote expensive market, something that's at its highest. I do understand that, but you got to take a step back, look at the data. The data still supports you that's probably still going to be a good investment decision, but it does make sense to look at your plan. If you're going to need income in the next 2 years, I don't want you to put it all in the market, but we got to we got to start with the end in mind. We got to look at the retirement income plan and build backwards from there. I mean, if you're 30 and you got a 35-year time horizon, I mean, dude, if you put it all in the day before it crashed during COVID, the 65-year-old you isn't going to know,
Yeah.
Yes, you could beat yourself up over that, but for the most part, we want to just be participating in this long-term upward trend. And then we want to have enough money on the sidelines to pay ourselves the income we need for the times that we're in downtrends.
Yeah.
And it's really that simple.
Yeah. I mean, see what your plan calls for, see what your plan allows you to do, or what the right decision to do is, especially if you do have some dry powder, as the saying likes to go, if you got something a little bit in cash on the side. But check with your advisor before you take any action, but it certainly is tempting because it's awful scary good right now. So with that, we'll wrap up our Halloween edition. But if you need some help, reach out to Scott. Don't be afraid to get onto his calendar. We'll have links in the show description below, and that way you can click on it. We'll also, you can check out the video here in just a second if you want to get the toolkit. That's a great way to get started as well. So reach out to Scott, have a conversation, and don't forget to subscribe to us on Apple, Spotify, and of course right here on YouTube. We'll see you next time here on the Wealthy Pilots Podcast with Scott Osborn, the airline advisor. Thank you, my friend.
Hey, my pleasure. We'll see y'all soon.
Have a good Halloween. We'll catch you next time here on the podcast.
Hey everyone, real quick, if you haven't grabbed Scott's Financial Flight Control Toolkit yet, now is the time. This is packed with tons of helpful resources and tools like this, Scott's book, The Dichotomy of Wealth, which is a pilot's guide to maximizing wealth and cash flow in retirement. You also get access to some great guides like this one, Advice Matters, which breaks down 4 key ways a good financial advisor can help you boost your returns over time. And guides like this one on the pitfalls of emotions when it comes to investing, and this one on the HCM byline investment strategy, and more. So if you'd like your very own Financial Flight Control Toolkit, just click the link in today's show description, and Scott and the team will be happy to get one sent your way at absolutely no cost to you.
information is for illustrative purposes only and does not constitute tax, investment, or legal advice. Always consult with a qualified investment, legal, or tax professional before taking any action.